The gold price's fall from its mid-April highs continues to extend on Monday as we've reached below $1,900 today. Joining us today, right now, to discuss gold's price action along with other market news is Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Chris, welcome back. I heard you were on vacation. I'm so honored that this is the first interview you're doing when you're back. Welcome back.
Yeah. Well, thanks for having me. Yeah, we're on 6-hour jet lag here, but these markets are moving. It keeps you wide awake.
You look good for someone who's supposed to be asleep. But listen, Chris, this is a tumultuous day in the markets, all markets. We're going to talk about stocks, the dollar, oil, gold. Focusing on gold first. We were so close to $2,000, Chris. So close, yet so far. And yeah, now here we are again. Resistance levels and support levels. Let's start with those first. So clearly we didn't breach 2,000. That was a key resistance level. Failed to break it. What's next?
Yeah. So if we were to look at my charts, the daily chart here real quick here, we had the big run up in gold and we had the war news hit and it really squeezed the price of gold up. We got pretty darn close to, depending on what contract you're looking at, this is the continuous contract. We got pretty close to $2,100 and we ended up seeing gold pull back and sell off. And since then it's been trying to build a base and recover. And it looked like it was going to break out about a week and a half ago and start another run higher, but it got stuck right under $2,000, poked up through it intraday, reversed back down. And of course, now we continue to see this really strong bout of selling. So 2,000 is definitely a major resistance area. The support zone, though, short term here is going to be around this 1900, somewhere down to 18, kind of 90 area. We've got a bunch of lows on this chart that it's been tagged several times. So this is definitely at a support level right now. If gold breaks down from here, then I think we could actually see it dip pretty quickly right back down to 1800, which will be more or less a measured move from this the high that we saw back in early March. Overall, though, if we were to look at it just as a grand kind of big picture here, the quarterly chart of gold is still extremely bullish. When you look at the quarterly chart of gold, it's had a huge rally up. We've had the multi-year base. Now it's testing this breakout with a cup and handle or a bull flag pattern, however you want to see that. And we're still really just, this is a small down red bar. It could come down to 1800 very easily and still be a very, very bullish trade long-term. So this is short-term volatility. It's got people talking, people worried, people selling, panicking out of the precious metals sector. And a good chunk of that, if we actually take a look here at my chart at this 30-minute regular trading hours chart. So this is 9:30 to 4 o'clock regular trading hours. And down here is the chart is the price of gold. And up here is a panic selling indicator I like to follow. This is the New York Stock Exchange down volume divided by the up volume. And whenever it spikes over 3, it's usually short-term panic in the market. When we see something around 8 or above, that is a pretty major wave of panic selling across the market. It usually ends up being a fairly significant low in the stock market. But when there's this much panic, to me, this is telling me there's 8 shares being sold on the bid to every one person buying on the ask. And when 8 people are running for the door out of 10, I mean, that is a pretty strong wave. And when people don't know what to do, they sell everything. We see this happen over and over again. It doesn't matter what asset it is, everything goes down. And gold obviously getting hit with the panic bleeding over into today. Energies are getting hit, stocks are getting hit. There really is no safe haven other than, bonds and the dollar can be a very defensive play during these very short waves of panic.
We're going to touch on this panic today. Well, Bitcoin's kind of flat, but that's a totally different conversation. But let's focus on the metals for now. Can you zoom out to the chart that you showed gold in the last couple of months? Let me clarify what I said at the opening. I said that gold failed to break above 2,000. I was talking about April. So yes, you're right. We had almost gone to $2,100 in March, but in the past, whenever we've had a breach above 2,000, if it fails to break the second time, what we saw, for example, in August in 2020, was that gold failed to break 2,000 a second time and then it went back down. And so we're seeing the same thing again. So one could argue that, Chris, maybe a trader like yourself wasn't surprised at this move down, despite the panic selling we saw today and the week before, despite equities markets falling. Gold was going to break down anyway. Could you make that argument?
You could definitely make that argument. 2000 is a mental resistance number, meaning it's a whole number. People like to sell something or buy something when it hits a certain level. And when something hits 2000, if you're underneath it, people are going to say, you know what, I'm going to sell gold if it hits 2000. They think it's resistance, which naturally causes the resistance because they become sellers there. And that's what's happened in this scenario. And the big question is going to be is how does this market recover from here? And if we were to use Fibonacci extension to get an idea of the downward momentum here, we can look down from the high to the low to this 2000 high and carry it forward. You can see gold's got potential to come all the way down to around 1811. That's the measured move based on the power of this sell-off, this rebound back up here, and this move back down. So naturally, this 1884 level, this area down here is going to act as a short-term support zone. And I think we're probably going to see some type of pause or bounce here. And my general rule is if you get a pause or a bounce for at least one or two bars after getting close to the 618 level, you almost always go down to hit that 100% measured move. And that would completely cleanse the price of gold. It gives you an ABC correction. So you've got an A, you've got a B, and you've got a C. Whoops. And it's this C correction here that breaks this previous low. Now you've made a lower low. That's where people panic. A lot of people will put stops in right around this low. And of course, it creates this waterfall sell-off. So we could still get a pretty big leg down. I do think it's going to come right into a major support zone where gold is traded before. The measured move should run out of steam. I think there's going to be bargain hunters down here, and it could very easily take off. The quarterly chart will be very bullish and points to much higher prices going forward after that.
Speaking of the panic selling we're seeing across different asset classes, yes, you're right. Typically, when there is major panic or even a fire sale situation, we see assets across the board fall as people raise money to cover their margins and raise capital. Gold is no exception. Of course, we've seen this many, many times in the past, but I'm looking at the markets. Yes, the stocks have fallen. The Dow's down 300 points today, but is it really that significant of a correction to warrant everybody panicking and selling their gold as well to raise cash? I mean, a 1% drop today is it's significant, but it's not a huge crash, right? I'm talking about the S&P 500.
You're right. The thing is, the market knows how to manipulate people. That the market moves pretty much on waves of people being fearful or greedy, and it doesn't take much to spook people. And we're starting to see this. This is the SP 500 here, and if we zoom out on the chart, this is a pretty gnarly looking pattern. We've had a lot of damage actually done to the chart. We came down, we made a low after breaking all three of these lows over here, and then we bounced up and kind of failed at the 50-day. It came back down and broke another low, and now we're kind of made a higher high. So it's a very mixed signal in this market. Basically, what's happening, what I see unfolding in this scenario, we've got major divergence. We've got most stocks in the stock market continue to be in a very strong downtrend. Very few are holding this market up. We've got precious metals have been holding up fairly well. Gold miners have been a leader as of the last month or so. Last few days have kind of removed a lot of that upside, but we're seeing defensive plays like utilities, consumer staples, healthcare perform very well. And the stock market is holding up, but with very few stocks. So this to me is a very bearish sign. We're close to the 50-day moving average, crossing down below the green 200-day moving average. That's not going to be a good sign for the stock market. Now, those are very long lagging moving averages, but at this point, it's still not enough to really have huge panic and sell everything. But the problem is, the average investor gets spooked very easily. So they could get spooked like this many, many times before we're actually in like a full-blown bear market going forward here. So, we've been in cash for quite a while, for several weeks here, because this market has been showing signs that it's on the verge of starting a bear market. It's also on the verge of starting a huge rally. And so we're in cash waiting to see which way this is going to break. But at this point, it's a very bearish picture still, and it's looking like it's going to be pointing towards the downside, which could lead to more panic selling, which could lead to more weakness in precious metals. Maybe not so much downside in precious metals, but more or less a sideways range. Well, because I do think gold and precious metals are going to become a defensive play. They might not sell off as much as the stock market, but if there is panic, it will hold the precious metals down to some regard.
You partly answered my next question. This is a question from several of our viewers. They want to know how you're positioned. I'm not even kidding. I'm going to show the comment on the screen. In prior videos, last week or the week before, I can't remember, somebody commented on another interview that I did. They said, is Chris Vermeulen still all in? I'd like to know. So I was going to invite you back anyway to comment on your positions, but you kind of answered that. So how are you positioned right now? You mentioned you're in cash.
Sure. Yeah. So depending on the time frame, we've got 3 different strategies that we trade, and they're different kind of asset classes or different strategies, different timeframes. So our long-term investing strategy for long-term capital, we moved to cash about 6-7 weeks ago. So we're standing in cash because this market is on the verge of a major breakdown, and there's no point in holding it. I'd much rather buy in when it's confirmed strength. So as an investor, we are back in cash, have been there for a couple of months almost. And as a short-term swing trader with all of our sectors, we are in cash as well. We closed out 6 winning trades in the past week and a half, and we closed them all out, and the market's been going down ever since. And we're looking for potentially inverse trades here. If this market does flip to a bear market, we'll be trading inverse ETFs to profit from the fall going forward. But we just need to see what the market is going to do. I don't try to front run big trend changes. I let them confirm, let them break, and then we start to get active with shorter term plays. So we are 100% cash in all of our strategies, and waiting for this to break, whichever way the market wants to break.
You went into cash before the panic indicator broke above 3?
Yeah, the panic indicator, that is a very short term. It only lasts intraday. So we'll see a wave of panic today or yesterday.
I didn't see the time frame on that.
Yeah, it's a 30-minute chart. And so panic is very short-lived, but it's a very good indicator of when it hits. And usually it'll tell you a good reversal. Very good for short-term trades. We trade it for intraday price action whenever we get it through the week. But it's all you need is one of these big waves of panic, which we had the previous session. And right now the stock market is down at support. It's oversold. We got panic selling. I wouldn't be surprised if we see the markets bounce and rally from here for a few percentage points. We'll have to see how it shakes out. But
I guess if the indicator goes to like 10 or something, that's a good place to buy. Am I right?
Yeah, generally it's a good spot to buy. Yep.
Yeah. Okay. You mentioned that should the bear markets happen, or should the markets turn bearish, we're not in a bear market yet already. I mean, we've been trending down for quite some time.
I don't think we are quite yet. We're in a bearish phase. Like Stan Weinstein, I follow his strategies. We're in like a distribution phase, stage 3, which is kind of like big companies. We're seeing big volume distribution. It's very sector. You have to be very selective with your sectors. Most stocks are going down, but some sectors are doing well. I mean, we're in this phase here where the market doesn't know what it wants to do. And once it moves enough in one direction, we're going to see a stampede effect of everybody follow suit. And we're very close to breaking the downside, where I think we'll start to see big institutions start to be, okay, we're in a bear market. They're going to start to liquidate even more. But right now we're just in this no man land kind of neutral phase that it could go either way. And it could be a very big move. Right now, it's a real crapshoot to trade in this environment. So we're just sitting tight here until we get some real trend direction.
Well, generally, how would you define a bear market? That scenario that you just described, how does that translate to price?
Right. So there's a bunch of different things that come into play. Obviously, you want the long-term moving averages. You want the 50-day below the 200-day. That's telling us the long-term trend is down and is weak. We want the 200-day moving average generally sloping down as well. That, again, is another kind of longer-term trend that's telling us that, hey, the trend is down, and the trend is more likely to continue than it is to reverse. So if the trend is down, it's likely to continue to stay down. We want to see a series of lower highs. We want to see a series of lower lows. We also want to see defensive plays come to life, which we've seen, oil. I think oil has probably had its peak. Precious metals were a defensive play. They had a big push up. I mean, war was a good chunk of why that actually rallied, but they were already doing fairly well before. We're seeing all the consumer staples, healthcare, utilities have been coming to life. So all the things that typically do well in the late stages of a stock market is what's unfolding right now. For example, if we just look at this economic kind of cycle phase, we've seen energy do exceptionally well. Precious metals were a leader for the last couple of months. Healthcare is doing well. Utilities are hitting all-time highs. I mean, they pulled back in the last week because of this panic selling. Everything goes down. But all these late stage sectors and assets have been performing very well. So we're close to this blue cycle here, which is a stock market top, starting to decline and move lower. And you take a look at like peak oil. Here's a chart I made of peak oil. So this is back in 2007. 2008, we had oil have that massive run up. Stock market had a big move, and then it had a peak and it sold off. And then the stock market, which is this other moving average down here, is the SP 500. It sold off as well. We've had the same type of scenario, massive run up in commodities in oil. I think oil is probably peaked. The stock market is starting to turn over. We're having the same scenario where sector rotations taking place. Fewer stocks are supporting this market. And I think we're about to see this roll over. I think commodities are starting to see, or oil, that the economy is getting close to, coming on a downswing, maybe weakening. We've got, recession, depending how you want to define it. I feel like we're already starting a recession. People are already cutting back on spending. The inflation has just been hit so hard. So oil, I think, is seeing that things are going to slow down, transportation, shipping products. So I think this market is very close to turning into a bear market, but we're not quite there just yet. We still need lower prices on the stock market across more indexes and things like that.
You mentioned sector rotation keyword. Okay, so are you suggesting that given your bearish macro outlook, there are still pockets of the S&P 500 that could do well? You mentioned that the defensive utilities, for example, have already done well. Will they continue to outperform in this bear market that's coming up?
They probably won't. I mean, once we start into a bear market, it's like a tide going down. Almost everything goes down. I think the dollar is actually going to be.
Suppose I have to be invested. Suppose I am a family fund or I'm an institutional investor with a mandate to be invested. What should I do? I can't just be in 100% cash.
Right. And that's where I struggle, because I don't believe you should be long in a bear market unless you're in something that is going to buck the trend. But it's very hard to do that. There's only small windows that something actually goes up during a bear market. Most of the time, it's still going to go down with it. If you had to be in something, honestly, I would think the dollar tends to do well when there's fear. We're seeing it rally again as there's panic in the stock market. Last bear market, we saw the dollar do well. COVID. I mean, the dollar is kind of a defensive play. I still think precious metals are going to do all fine. I think long-term, they're going to go a lot higher, but it's really tough because, believe it or not, utilities and high dividend stocks actually have some of the biggest corrections. They pulled back more than the major indexes during the COVID crash. And the reason being is you see most big investors, they dump their money into the big blue chips, the high dividend paying stocks. So when they get scared in a bear market, they start to liquidate, and the dividend stocks actually get hit more than everything else. I mean, I did some charts showing it. It's brutal how hard the high dividend stocks get hit when the market actually starts to sell off. So I would steer clear of dividend stocks, because once the masses start selling, those are the biggest companies. That's where most investment capital is. And when the investment capital gets nervous and starts selling, those are the stocks that get hit. So I mean, that goes against everything that I believe in, that you shouldn't be holding something during a bear market. That's why I'm a technical trader. If I wanted to buy and hold, it'd be a totally different story. But I believe you can dance around this market and avoid these massive bear markets, because if you can avoid just one bear market in your life, you're probably going to double or triple the amount of money you have when you retire, or you can retire probably 5 or 10 years earlier. And most of us lived through 2 or 3 bear markets. So why would you not want to protect your money and try to, be more aggressive to dance around this market?
We're going to come back to precious metals, but I want to finish up on the stock market now. There, I've noticed about you. You've mentioned that you're on the sidelines in cash, but you haven't said that you're shorting. You're actively shorting. Are you?
No, not till we're in a bear market. When we're technically in a long-term bear market, that's when we go to our short-term strategies and we, in a roundabout way, flip the strategy and we start to buy the inverse
All right.
ETFs when we have a sell signal. So we're not there yet. We don't bet
Okay.
against a bull market or a sideways market. We're always going to be looking to buy long until we're in a bear
Okay.
market. Then we're only looking to be inverse or cash.
Interesting. So we're still technically sideways for now. Okay. So you've mentioned your indicators for a bear market starting. Give me a call, of course, when that happens. We'll have you on as soon as that comes on. Now, at what point at the bottom would you say to yourself, all right, this is an entry point for me? In other words, how low can the S&P 500 go before you're comfortable getting back in?
Right. So I don't buy into selling. So it'll be after it has put in a bottom, probably a very sharp drop and a sharp reversal and starts to rally again. I'll get in much later when it started to rally and everything is confirming from a technical standpoint that there's legs behind this trend. So I won't, like, if the SP 500 was to fall down to like 4,000, I wouldn't just jump in and buy it. That's not the type of
I know people can't, it's difficult to time tops and bottoms. I'm just, the strategy that you're telling me about right now, you're missing gains on the bottom and the top, right? But that's okay with you?
For sure. So if we were to take a look at the SP 500 chart here, just real quick, for example, our long-term investment strategy, we ended up getting long here after COVID. We don't buy at the bottom because you never know where the bottom is.
Yeah.
And we ended up exiting on the trade somewhere over here.
Right.
And we got in, we wrote all this up. We wrote it all up and then we got out over here when the markets actually started to break down. We made 40% on that play. And here we are in cash now waiting to see, what this market is going to do. Which way is it going to break? What's it going to do? Whichever way it goes, we'll look for an inverse trade if it breaks the downside or the long side. But you'll notice we'll never buy in at the bottom. And the crazy part is this is what get a lot of people confused. I mean, we missed a 27% rally that happened in a couple of weeks. And of course, the market sold off, 5-10% from where we got out. We're never going to get in at the bottom or the top. The key is catching this middle safe area. We want to just catch the trend section. And that's the nice thing about long-term investing is we can play these big trends. We can avoid most of the volatility. And we're not going to be holding a falling knife when it does collapse. There will be a point we'll be back in cash. So that's just the way I see it. I don't try to pick tops or bottoms.
Okay.
And yeah.
You didn't go heavy into cash at any point between April 2020 and I guess when you exited for real a couple months ago. This whole run here. I mean that was all in.
This whole run with our technical investor. Yeah. That's one position. Okay. So that was one, and then in here we got in and out a whole bunch of times through a whole bunch of different sectors with our shorter term strategies. Because you and I have talked. I'd say I'm in cash. Well, that's our short-term strategy. We're in cash, and then we get a new buy signal. We move into the leading sectors. So depending on the strategy, you move in and out. But the key is, you just have to move around with this market.
Fundamentally still strategy. Long. You're fundamentally still long, is what you're saying. Yeah.
Yeah.
Okay. Perfect. All right. So let's close up on the precious metals now. We've talked about. We've talked about gold in the beginning. I'm going to close off on gold again. Now, it just strikes me as gold not performing as a safe haven asset when it should have been. I mean, yes. Like during a panic, like we just discussed, during a market panic, everything sells off. But at what point you would expect gold to stabilize, right? When is that going to come?
I think gold is stabilizing. It really depends on your view. I think, when we take a look at this, I think this is gold. It had a big run up. This is gold trying to stabilize, and it's actually already on the upswing. Like it's already moved down, and I think it has stabilized. And all this is short-term volatility. The thing is, gold and silver, especially the miners, they're some of the fastest moving sectors. Same with the energy stocks. They're very fast moving groups, and you have to be able to really manage your positions and your risk and your entries and exits because they turn on a dime and just collapse. So it's very tough. But in the grand scheme of things, this big kind of saucer shaped bottom here is gold stabilizing. And I do think it is on the upswing. It might still have some more down action over here. I think it's going to be a wild ride still for several more months. I think it's got a lot of work to do to work itself through here. I would love to see it stabilize and start to move up sooner than later.
Yeah.
But this pattern is actually showing, 1800 coming right back down to the middle range of all this noise. So I wouldn't be, hugely surprised if that happened. And this is one of the issues I think a lot of people get stuck into is they fall in love with a specific ETF or a sector like precious metals or miners, and they feel like they always need to trade them. And the problem is you're looking to trade, so you're going to find, your brain's going to find trades to get in. And I kind of do the opposite. I sit back and I don't really care what I get into. I wait for something to set up and then I move into it. And, gold to me is a great long-term play. The miners are a great long-term play, but right now they have rolled over in the last week. You should, in my opinion, you should be in cash. I think they could go quite a bit lower still before they put in a bottom. They were starting to break out. They looked like a great trade, but it failed. I mean, it's been rejected with the panic selling. The strong dollar is driving metals lower. And I think you should be kind of waiting right now. If gold was to get down to 1800, I think that would be, for an aggressive trader, that would be a point where we're probably going to see gold bounce. If you want to get into miners, that would be an oversold level to jump into. But miners will be in a downtrend, and I don't buy stuff that's in a downtrend. I'll wait for it to reverse, turn back up, and build a bullish chart pattern. So, my style is very different than a lot of others, and it's a little more, it's slower, it's more passive, much more conservative. I'm not looking to buy, the blips and dips on the charts. I'm trying to catch the underlying trend and then ride it for as long as we can.
You don't think 1700 is going to happen? I've heard that from somebody. Just getting your thoughts.
It's possible. I mean, based on the analysis that we drew here with the Fibonacci extension, 1800 to me looks like the sweet spot. Okay. Just drawing a line across this chart at 1800, it's, you'll see that it was a major level here, major low. We had a bunch of wicks close to it, bunch of highs. It traded through a lot of noise. It's kind of like the middle range. If I was to put probably volume by price on here, you'd see there'd be a ton of volume through there. That's where there's going to be naturally a lot of people accumulating, adding to their positions if it dips down to that level. So I think the 1800 is a very significant one. If it goes down to 1700, I think that's going to do a lot of damage to the chart. And we really don't want it to go that low. That's getting a little low, but it's possible. But 1800 seems like it should be a pretty solid level if this 1880 doesn't hold.
Okay. All right, let's close it there. I mean, those are good thoughts. So bottom line is you think that gold is more or less stabilizing right now. I guess shorter term traders are probably wondering whether or not this decline that we've seen over the last couple of days, consecutive declines over Friday, now today, is this the bottom short term? You're saying potentially 1800 is the floor or no?
So for short term traders, I would look at it, there's two different levels here. So we just had panic selling in the stock market. Gold has dropped right down to support around 1880 here. To me, this is a level where we're probably going to see a bounce. I wouldn't be surprised if we see gold, silver miners bounce for 2, 3, or 4 or 5 days. There could be a really nice bounce right here. But if it rolls over after that bounce and keeps going down, 1800 is the next really critical level to play a quick bounce or to buy and hope it actually starts a new rally after that.
Okay. Well, perfect, Chris. Excellent thoughts. Thank you for your analysis. Thank you for coming on today. Speak to you next time.
No problem, David.
No shortage of market volatility to talk about in the coming weeks, I'm sure. So we'll be in touch. And thank you for watching Kitco News. I'm David Lynn. Stay tuned for more, and don't forget to subscribe to our YouTube channel.